This is the monthly in-house financials webinar. And what we're going to do first is we're going to kind of go through the objectives, and then we'll talk about the specific concepts that we're going to address. So the objective of the webinar is to help you produce an example set of working papers, or at least introduce the concepts that allow you to, so you'll have a reference in producing your own in-house working papers, okay? Now that screen on the right-hand side, you can minimize it by hitting that orange red arrow on the upper left-hand side of that vertical dialog. Okay, so we're going to cover concepts that lend to consistent in-house financial statements. Okay, so one objective of an organization is to be able to give itself a report card, or have the monthly financials be a gauging point to set, to help with motivation and help keep track of where you're at. So the monthly financial statements is somewhat of a report card. So if you can be as objective as you can possibly be with that internally, then you'll get a report card on how you're doing from month to month, and it can be a motivation factor. Okay. So the reason to have a set of in-house work papers would be to document, is basically documentation supporting. So the reason to have a set of in-house working papers is documentation supporting the amounts in your internally generated financial statements that you can refer to at a later date to answer, spell that correctly, questions should they arise. So it's basically the support for your conclusion. So if, let's say you made $10,000 last month, or $100,000 last month, how did you get to that conclusion, and how do you substantiate that conclusion? And this is basically your support for that conclusion. And it shows that you've done the work to try to ensure that you've got accurate financial statements. And so another purpose would be to lend to the concept of consistency. So we want to consistently be accurate. Okay, so if you produce a set of working papers and that support your monthly financial statements and the journal entries that you may be making to get to a point where your financial statements are fair, if there's questions as to its accuracy, you've got the support that you put into it. So if the financial statements, if you say you made 10 but you really didn't, then that's not what you want, right? So how do you produce a quality in-house financial statement? And that's to perform a list of monthly procedures that include tests of balances on your balance sheet accounts and other analytical procedures. So a test of balance is something that basically supports the balance. So your balance sheet, in your balance sheet you have assets, liabilities, and equity. And everything on your balance sheet can be substantiated with respect to your assets and your liabilities. So let's cover the test of balances concept again. We've covered in some of the other webinars, but let's take a few minutes and talk about it. Okay, so we have our balance sheet, and it includes our assets, our liabilities, and our equity. So our equity is defined as the difference between our assets and our liabilities, or our assets minus our liabilities. And our assets and liabilities can be substantiated. For example, a cash account, you can produce a bank reconciliation, and you can do certain steps or processes or procedures on that bank reconciliation to help with its accuracy. Okay. Same thing with all the other cash accounts. The receivables, you would pull up accounts receivable aging. You'd go through all the items on the aging, with respect to making sure they're accurate, and maybe set up an allowance for doubtful accounts if you have some older items on that aging, so that you have a fair presentation for your accounts receivable. So not only does the aging tie into your trial balance, but also everything on it's reasonable and accurate, and an allowance has been set up for old items. Cost plus earnings in excess would be your over and under billings, part of your over and under billings, and we'll talk about that later. And then prepaids and inventory. Fixed assets, you have a depreciation schedule. depreciation schedule would support your accumulated depreciation. Deposits, you might have basically a deposit with your lease or your landlord, that kind of thing. On your liabilities, you would have an accounts payable aging that supports your accounts payable, and you would do work on that to perform your tested balances for accounts payable. Accrued wages, you would accrue wages through the system. Utilities accrue wages, and we'll talk about that. Your line 41 liabilities and your state withholding, unemployment taxes, you would do work to support the liabilities that are on the books there. Workman's comp and the other liabilities. Notes, you would have amortization schedules and maybe support from the bank, some sort of statement from them. So if we can prove the balance on every balance sheet account, it shows, then we'll prove the difference between our assets and liabilities to be accurate, and the difference between our assets and liabilities becomes our equity. And the change from your equity from one year to the next, or one period to the next, is really your net income. If you have distributions or dividend distributions, it would be the combination of your dividend distributions and your net income. So if you've done a test of balances at the beginning of your fiscal year, and you've done a test of balances at the end of a month, for example, January, then you've proven the balance sheet in both time periods, at the end of both time periods, at the cutoff date of each, at the end of each time period. And if you've proven your balance sheets at two different intervals, the net income of the company is going to be the difference between the equity positions, basically from the end of the previous interval to the end of this interval, or the end of the previous period to the end of this period. So that's the concept, and that's how we prove the financial statements are accurate. So I practiced in public accounting for 18 years, and one question the owners would ask is, how do you know the financial statements are accurate? Okay, and that's the answer. Okay. So what is a tested balance? We talked about that. Process of substantiating your balance sheet accounts, balances. How do you represent that your in-house financial statements are fair? You perform a list of monthly procedures that include tested balances on your balance sheet accounts and analytical procedures, and produce a set of working papers to support your work. What is an example of a substantiation of a balance sheet account? A bank reconciliation on that account, tying the bank reconciliation to the monthly bank statement would be an example. Also, you would do additional work on that bank reconciliation, identifying any old and outstanding items that are never going to clear the bank and getting them off your rec. Okay. What are examples of other analytical procedures? And I just got ahead of myself on that. Review the bank reconciliation for old outstanding checks or deposits in transit. If an old check that is never going to clear the bank is an item that you would want to get off your bank reconciliation. How do you prove that you've done work to ensure that your in-house financial statements are accurate? You produce a set of working papers that can be referred to should questions arise regarding those financial statements. Your equity position, the difference between your assets and liabilities. How do you prove your equity position? You substantiate balances for each of your asset accounts and each of your liability accounts. Okay, so that substantiates the equity position because it's the difference between the two. And then what is a cutoff date? The cutoff date is the last day of the month or period for which you are producing financial statements. In our example data, we're looking at January 2013. So 1/31/13 would be our cutoff date. What is the significance of a cutoff date? It provides a date that you can use to substantiate your balance sheet accounts. So usually, let's say it's January 31st, and you have invoices coming in for January. It could be February 5th, and you could still have invoices coming in that are dated in January. And so we generally use the invoice date as our objective criteria. It's sometimes a subcontractor will bill you on the second of the month. Let's say you're a general contractor or you're a sub that has subs, and the sub sends you an invoice for this, and it's dated the second of the month, but it's for the work in January. I would cross through the date, put January 31st as the invoice date, and put it in the system as of January 31st because the sub did the work in January. So that's not always an objective criteria, but which you should generally use. Okay. Period versus cutoff date. Okay, so a balance sheet is as of a cutoff date at one date and time. So what was the cash balance at December 31st? What was your accounts receivable total at January 31st, okay? An income statement account is not a balance as of a cutoff date. It's the running total of amounts being posted to that account for, from the beginning of your fiscal year through that cutoff date. So that's a period. So balance sheet accounts deal with periods, and liability and asset accounts, or balance sheet accounts, let's see, income statement accounts deal with periods, and balance sheet accounts deal with the cutoff date. Balance sheet account has a balance that can be substantiated as of a cutoff date. An income statement account has a running total balance from the beginning of your fiscal year through your cutoff date. So what is the difference between the equity position at the beginning of your year and the equity position at the end of your year? It's your net income, okay? It could also be, you could have issued stock or capital contributions, and you could have dividends or dividend distributions, okay? So it would be the combination of the three, essentially. So for example, you have a balance sheet equity account at the beginning of the period, and you have a set of working papers to support the equity position at the beginning of the year. The company made $200,000, distributed $100,000 in dividends, dividend distributions, and then you have an equity account at the end of the year, and you have a set of working papers to support the equity position at the end of the year. So this is what basically goes on, and this is how you support your numbers. Another way to state the change in your equity position from the beginning of the year to the end of the year is your accumulation of wealth for the year. Okay, so so the difference between the equity positions essentially is an accumulation of wealth between the time periods, and the accumulation of wealth would be the difference between the income and what you distributed. Okay, so there's some basic concepts or terms. Okay, so now we're going to move on to the concept of your working papers. So the first thing you're going to see in your set of working papers is an index, okay, like a book. And so you're going to basically build a book or a set of working papers for your month end. And your index, you can, one thing I recommend is getting an index from your CPA firm. But here's a simple index, and it can be simple. It doesn't have to be difficult. So the first thing we're going to have is a trial balance. Then we're going to have our cash working papers, our accounts receivable work papers, our prepaids, fixed assets, notes payable, accounts payable, accrued wages, other accrued liabilities, equity working papers. So a good equity working paper might be the second page of your balance sheet, or the page of your balance sheet that includes your equity section from the end of your previous fiscal year end. So if we look at the equity section at the end of January, and you say, well, how do I know this ties into my financial statements that were audited or reviewed or compiled? And there's an opinion on those financial statements from my CPA firm. Well, I look at this number, the retained earnings, and that should tie right into that statement. So a good T-work paper for the year would be that one page, and just make sure every month that number ties in. The first thing the banks and the bonding companies are going to do is make sure your in-house financial statements tie into your prior year end. Okay, so that's an example there. We're not going to probably cover much more than that. On that, now in this index, W would be your job costs and billings job billings and cost tie out with your over under billings computations. Okay, so that would be your index. Your trial balance then would be basically your trial balance with some sort of tick mark next to everything. And so you might print out your trial balance to start. So in our case, our cutoff date's 1/31. And then we would be looking for some sort of tick mark next to each one of these. So if B1 has my bank reconciliation, I would put B1 next to this. My bank reconciliation so there's my bank reconciliation. Let me finish. So the bank reconciliation, this would be maybe your B1 work paper. You would label it B-1. And then you might have, people do their tick marks in different ways, but generally a tick mark before the number is going to show you that there's a supporting work paper, and a tick mark after is going to show you that it supports something else. So on your work papers, a tick mark after would mean we're going to support the balance sheet. So you might put A-1 if that was your trial balance working paper. So if we come over here, we look at our index, and if our trial balance is A, so A-1 might be the first page of my trial balance. And under my trial balance, I'm referencing I have a column for references rather than putting my tick marks before and after my numbers on the trial balance. It's fairly standard. So you would put B1 here, and then on your B work paper you would put, or actually this would become your B1, you would put B-1 or A-1 after it, meaning it supports your balance, your trial balance. Or TB for trial balance, that it supports the trial balance. Then over here you'd have B-1A, and that might be the page of your bank statement that has your current balance, your ending balance. Actually, that would be right here, your ending balance from your bank statement. So that's how that would kind of line out. I want to cover one quick thing here. So this is the traditional bank rec, the TimeSuite bank rec. We've produced that now, and you can bolt it in as a bank rec, even though the bank rec for the TimeSuite site is not released. So you come over here to Custom Reports and Forms, you can actually print it. So it's a Crystal Reports generated bank rec. So the bank rec on the toolbox side, the older system, it was a system. It's one of 3 or 4 system generated reports are still there. Ended up coming in the background. I didn't put my GL account to rec in there. That's what happened. So you have to key the parameters in manually if you do these. If you do this bank rec. And for some reason it's not jumping in front. So anyway, so it's basically the same thing. It's got more to it, and you've got a second page that has your bank statement recap numbers on exactly what cleared the bank. Kind of a concept. So it's the first iteration of it. I think it's pretty well done, and we'll continue to enhance it as we go. Okay, so we're on our trial balance concept, and we are looking at our cash balance, our cash account, and the support of it's is going to be our bank reconciliation, which we looked at. And then on this Google Doc, you'll notice that across the bottom we have the working paper numbers that tie into our index concept. So B was cash, and we're just going to talk about the steps that you would take to make sure your cash working papers are okay and well done. So your bank reconciliation for each account, get the old outstanding checks and deposits off the bank rec, copy the bank statement, or at least the front page of the bank statement to support your numbers that are on your bank rec. Organization of your working papers. Maybe B1 would be your first cash account. B2 would be your second cash account. B1A might be the first page of your bank statement, and B1B might be the second page, or however you decide to do that. You could also do B1-1A for B1-1 through B1-1C for your bank reconciliation, and B-1-2A would be through 2E, for example, might be your bank statement. I don't think there's a wrong way to do it, just something that makes sense, just some suggestions. Other concepts, register. How do you register a check to be voided? To register a check as void, enter it through manual cash disbursements and choose the void vendor. So we'll just do that real quick. Manual cash disbursements. And let's say we're going to use a special vendor called void, and you'll notice that that vendor is not in the vendor list. It's a hidden vendor in the system. And you'll leave this at 0. And let's say this is 9098 was voided, and maybe it was voided on 1002, and you just hit next. And then it'll show up in your bank reconciliations area as a voided check, okay? How do you clear old outstanding items? You do a journal entry, debiting cash and crediting expense or miscellaneous income. So let's look at the bank rec. Let's say we're looking at, we have a $12,000, 12/12/2012 old outstanding check that will never clear the bank, for example. Over here, journal entry. You might post it to, like, if the job's still open, you might post it to the job. Here we'll just post it to miscellaneous income. Click OK. Go over here to the cash account, reconcile. Okay. Okay, so there's the deposit and there's the check, right? Actually, there's the deposit. It's going to offset this old outstanding check, so I'm going to have to, without changing my cash, without messing up my bank rec, I'm going to have to do this. So I'm going to say, there's my journal entry I just did to increase cash for the 978, and then there's my old outstanding item, and I'll clear it. And this number on the bottom right, if I get the bank rec, two versions of the bank rec up in at one time, because I can go into this as many times as I want. See this? It actually balances. This is a little bit of a nuance that is a little bit annoying, but if I go into that same bank reconciliation multiple times, see that? This number can be off, so don't, if it's ever off, make sure you search for your bank reconciliations that are open and get them closed, and then just be in there one time and you should be fine. Okay, so now it's fine. When I first go in, it doesn't pull the numbers from the other tabs until I click on the tabs. So here and now I'm going to check the 978 here and here, and you're fine. Okay. So now these numbers don't tie into exactly what came off the bank statement, but they're both off by that 978. They're both high by that. And essentially you've gotten the old outstanding check off the books. Okay. Okay, let's move on to accounts receivable. So how do we know, what are we going to do with that? The system, in various areas, we've produced reports that help you with your work papers. For example, we've done this aging to GL reconciliation that can be used as a lead sheet in your accounts receivable analysis or set of working papers. So you go AR, and you go aging, and you go aging to GL reconciliation. Now, by the way, that same exact report is in the menu system under accounts payable, and if you run it under accounts payable, you still have to select accounts payable. But just so you know, that's how you do that. So just make sure you pick whether it's receivables or payables. And then the first cutoff date would be the end of your fiscal year, previous fiscal year. And then the second cutoff date would be the cutoff date that you're doing your work papers for. And here you have your accounts receivable aging to GL reconciliation. This is the demo data has got some conversion concept going on there, but what you're looking for is a difference of zeros here. We didn't quite tie out there. I'll go ahead and rebuild it. Hold on. So we can pick up the recording. Okay, so for accounts receivable, the aging to GL reconciliation report is a report you can use to substantiate your balance. So you have to select AR for accounts receivable. the end of your previous fiscal year as your first cutoff date, and the end of your fiscal year for the second cutoff date. And so then you get your trial balance at the beginning of the year and your aging at the beginning of the year and your difference between the two. And then same thing at the end of the month, your trial balance, your aging, and the difference between the two. And remember, if you see a blue, like a navy blue number, that means there's an on-demand subreport behind it. And so if I click on it, it'll bring up the trial balance for 12/31/2012 in a separate tab. So if I click on this number, I'm going to get the aging as of 12/31/2012 in a separate tab. Do the same thing over here to get your 131 trial balance. One thing about this trial balance, it's a little different than the other trial balance in that it does identify the control accounts, the types. Sometimes we'll get a call in where this will actually agree, but when they look at the trial balance, they won't be able to figure out why the number they see is what it is. So they might see a number here that's different than this number, but they might have two control accounts for accounts receivable. They might have like another one here. Any differences between your agings at the beginning of the end of the year should be in this section, should be detailed out, and there should be no unexplained difference at the end of the two periods. And if there is, you can do a support call and we'll run it down for you. In that context, over a period of time, not much can go on with that. So if you do have a difference, you're doing everybody a favor. If there's something out there that can happen that means there's an unexplained difference. So E1 might be your aging to GL reconciliation report. Your aging itself could be your E2 work papers, E2A through E2M, that kind of thing. Tested balances, verify the aging trade, or verify AR trade aging ties to the trial balance for both trade and retention. Okay. Verify everything on the aging makes sense. Okay. Contra account versus bad debt expense, contract account versus bad debt expense. So here's a couple concepts. Now another thing you could do is with your tested balances, this is what sometimes the CPA firms will do, is you can you could do some tracing, like if it's subsequently collected, then that means it was good, right? So you could do some analysis that way. I would go through all your old outstanding items and set some sort of allowance for doubtful accounts up so that your aging's fair, okay? And if you have questions on that concept and how to do that, you might talk to your CPA. Contract adjustment versus bad debt. So, for example, let's say you're on a job site and one of your guys destroys something on the job site. So, and you're a subcontractor, for example. So, the general contractor may get someone else to fix what was destroyed, and would back charge you. And so, a back charge. Maybe the back charge is not on your books, and so all of a sudden you just don't collect all your money from the general. So then you have a receivable on your books. So how do you get that receivable off your books? And the answer is not to run it through bad debt expense because it's not a bad debt expense. It's just a cost of being on that job site. So you would do some sort of adjustment, maybe a negative AR invoice, and post that negative AR invoice to other costs of construction. So you'll increase your cost and reduce your accounts receivable. That would be the right way to get that off the books. Bad debt expense get cleared through an increase in bad debt expense and a reduction in allowance for doubtful accounts. So what we're saying here is it's either or. So it's either going to increase bad debt expense or reduce the allowance for doubtful accounts. So let's say you have a hung receivable of $30,000 on your books. And you think, well, we'll probably get 20 of that. It's probable that we'll get 20. That's what your criteria is supposed to be. What's the amount I'll probably get? Okay, so let's say you end up getting the $20,000. But at the end of the prior year, what you did was you debited maybe bad debt expense and credited your allowance for doubtful accounts. So then the allowance for doubtful account might have the what you're eventually not going to get, so that you would end up adjusting your allowance for doubtful accounts. Now, another type of contract adjustment might be, let's say you submitted a change order and it was probable that you were going to get it, and all of a sudden you didn't get all of it. You wouldn't be running that adjustment through. You would end up with a number on your accounts receivable list. You'd end up basically getting it off your accounts receivable list by reducing your revenue on the project rather than increasing. In that first example with a bad debt expense, or I'm sorry, with a back charge, you would increase job cost to get the receivable off. In the second example, we're going to increase bad debt expense to get the receivable off, or decrease your allowance for doubtful accounts. And the third example, where you'd have a contract adjustment, you'd actually reduce your revenue. So it kind of depends on the character of it. When your financial statements are analyzed by third parties, bad debt expense is not something that looks good, and a lot of times with a contractor it's not the case. So getting an old AR invoice off your books, consider doing a negative invoice instead of a positive. Instead of posting a journal entry, then you will have to do a 0 AR receipt to clear the positive and the negative invoice. And let's go through an example of that. So let's say on our aging, we have an old item. Let's say it's a 6120. It's Monte Vista project. And so let's say, depending on the character that we're going to do, we're either going to send it. We're going to send it somewhere. So we'll just go City of Monte Vista. We'll say maybe say right off AR. Okay. So in this case, let's say it's bad debt. So a negative invoice there. Then we go to AR, receive payment. And then we have our negative and positive here and here. Okay? And then just whatever your reference is. So that should be 0 when we get it done. This thing has got a discount put into it, so we'd have to get that off for our example to be clean. So now we're down to 0 here with the 0 unapplied, and we click OK, and it gets both off the books. So that's what we mean by a 0 cash receipt. Okay, so now we're on the G tab, and maybe prepaids and insurance, that kind of thing. So the suggestion would be to scan your policy pages into your vendor for your workman's comp. Sometimes people call in and they need help calculating what goes into this section. So under accounts payable, vendor list, in Colorado, it might be Pinnacle Insurance. And we would go to our attachments and we'd click select, or we would click scan, and we'd get an image of that policy. So then you're going to calculate your effective rates for your workman's comp and put them in here. What the system is going to do is it's going to, every time a time card is generated or a paycheck is generated, for each row on the time card, it's going to figure out the expense, and it's going to debit your expense and credit your liability account. So here you put your expense accounts. So for every direct labor posting, you're going to post into, it'll get posted in there. Okay, so then you get your general GL reconciliation or GL associations there. When you double click here, you'll get your liability account. So basically, for each paycheck, the system is going to increase expense and increase your liability. So then when you pay your liability, your vendor, you need to make sure your vendor is set up so that you will offset your liability account. Because if you send it to expense, you'll double up your expense account, and your liability account will just get increased and never decrease. So if we look at that liability account, 2250, we'll see that activity where here every paycheck is getting the workman's comp credited that we owe credited into the account, and then as you make your payments, they should be offsetting those credits. And so as long as your rate's correct, this should always be correct. So a test of balances then would be to support that. So what you would do is you would run your workman's comp report, one of them. Let's say your policy ended at the end of the previous fiscal year. Let's keep the example simple. And so then you would be looking for your cost since the beginning of your fiscal year. So here, this is calculating the workman's comp premium. And there's the total. And so for that period, you'd have this. This is your total cost for the period. Subtract out the payments and then subtotal, and then you would get your liability, and then you would tie it in and compare it to the liability in your general ledger. As of that date. Here we go, that's what we're looking for. So you would go to the end of the month, the last row, and this is the number you're looking for to support. So your computation would be what did it cost you for the period, less your payments, and see if that agrees. Also, what could come into play, let's say at the end of the previous fiscal year you had a liability, and let's say they haven't audited you yet and charged you for that. So whatever your costs are on the current policy period, plus or minus where you're at with your prior policy period end, and so that could come into play as well. So one suggestion for your work papers, depends on the size you are, but I think this webinar is more for people who are trying to get that part done. So you would produce a set of working papers for your CPA firms. This is how it's supposed to go, and they would review it. Would review your financial statements, maybe if it's an audit, they're going to do additional auditing procedures, and then they're going to render an opinion on your financial statements. And if depending on your size, the CPA firm may produce those working papers for you, or that might be, they might have someone come in and do that set of working papers for you outside of their firm. So your objective is to do your own set of work papers so that you can get, further along and more sophisticated. But my point is to get a copy of whoever's produced those in the past. And maybe you're already doing it, but your CPA firm definitely has a copy of those working papers from the end of the previous fiscal year, and you could look and see what they did for the workman's comp and how they came to their conclusions. And then if you didn't understand how they drew their conclusions, then you could ask them and try to produce something similar. So for example, we're going to go through an example here. So let's say you're going to scan, so we're talking about maybe scanning that policy, and then so that you scan the policy, the page that includes your base rate, your discounts and premiums, and total rate. Okay, typically the base rates are broken down by the work comp classifications. The classifications are identified with base rates and projected labor. So at the first year policy, they're going to project your labor forward and make you pay monthly based on projection, or maybe you'll file a monthly report that includes your actual labor. So we need to use the base rate and the discount premiums to compute the effective rate. So we identify a policy, the policy period, okay, and then in this example, then we print the workman's comp report that calculates the premium for that period, just like we kind of did for January. And so that's what we did that, and the amount's $13.61. Okay, then you itemize the payments that you've made on the policy. Okay, that's what we talked about. And so then the difference between the calculated premium and the payments will equal your liability account. So that's what your liability account should say. Then you look at your previous policy and determine what your audit liability or prepaid has been or should have been. Okay, and then maybe your calculated liability at the cutoff date. Now, if let's say you calculated $58.99 and the liability came in at $58.99, this would come off your calculation. So let's say at February you settled up with them for your December number, so this would come off. Okay, compare the calculated liability with general ledger balance, and then you would do a journal entry to adjust the difference. So you have a debit to that account and credit to that account to get your calculated balance get your general ledger to agree to your calculated balance. And then you'd have a reference mark to A-1 to support your trial balance. So if we come over here to the trial balance, we look at our G work papers, we should see that. So the 4513, that's before the adjustment. After the adjustment would be 4489. And then we would say G dash, maybe G dash 1, okay? And this number, after we do our journal entry, will be 4489.61. Okay. So the general liability in the system works exactly like the workman's comp if you base your general liability insurance on labor. So generally subcontractors will have, or labor-intensive general contractors will have their general liability based on the same concept as the workman's comp. And if you come in here, you'll see that you can set your liability up and your rates. The rates on your policy and your general liability are usually a rate per 1,000 rather than a rate per 100. But it's basically the same concepts, and then there's your expense account associations for every labor account. Your line of credit, you may get a statement from the bank and make sure that that agrees. You know, make sure your depreciation or your interest expense was recorded correctly, that kind of thing. On your fixed assets, we don't list it in here, but you might have a monthly depreciation expense, monthly depreciation entry from your CPA, that kind of thing. If you do your depreciation through the system, you could print out your depreciation schedules. Notes payable, you'd have an amortization schedule and or a statement from the bank. So let's go through a set of I work papers. In this case, I was our fixed assets, and you'll record a monthly journal entry and or record depreciation through utilities accrued depreciation monthly. Monthly depreciation, indirect depreciation expense, G&A, accumulated depreciation. A lot of times CPA will just give you a journal entry and just do it that way and keep it simple. So heavy equipment and other fixed assets that are charged to the jobs on a unit basis through payroll and equipment transactions. That's the concept. Your depreciation schedule should be entered into the fixed asset subsidiary. So if you have heavy equipment, that's a substantial expense. And the way you spread those costs, which are job-related but difficult to apply, because you incur interest expense, maybe lease payments, maybe depreciation on the assets that you own, and those will typically go into your indirect cost section. They will go into your indirect cost section, and it's almost always wrong when it's not in there. Or if it's posted into G&A, that's not the right place for that. So if we look at this trial balance, we see equipment in this section in this limited area, and then we'll have equipment cost allocated out and up into the job cost, and that's how we allocate the costs. This is done through, it can be done through an equipment transaction, or it can be done through payroll. And on the time cards, you'll have your piece of equipment items on there. On the heavy equipment, there's a document under the help screens that lay out the concepts. So if we go white papers and knowledge base, and we can say heavy equipment contractor concepts, and it's a good synopsis of what you're up against. So I won't go into that too much more, but basically you're going to pool your indirect costs and apply it to the direct cost section. Your monthly depreciation is utilities accrued depreciation monthly. Some people use the fixed assets area, and they'll put their depreciation schedules in there, and they'll use it to do their monthly straight line depreciation. And I think that's fine, but if you have heavy equipment, you really need to do that. And if you have non-heavy equipment, I think keep it simple might be okay too, and not use the fixed asset area. So here's some examples of what your additions and deletions schedule can look like to support your changes in your fixed assets from beginning of the year through now. Analytical procedures review your depreciation schedules and comparing to what you actually have in the field. Compare. Okay. Make sure you actually have everything. Everything you have is actually on your depreciation schedule. So let's say you've got a skid steer out there, and 2 years ago somebody charged it off to expense, and that, all of a sudden you don't see it on your schedule. That can happen. Those kinds of things can happen. So if you had caught it 2 years ago, you wouldn't have the misstatement. So make sure that everything on your schedule actually exists. So we're missing things from the schedule here, and let's say we wrecked a vehicle and it's still sitting on the books and it should have been taken off before. Okay. So that's the scope of your fixed assets on your monthly financial statements. Some concepts for that. So the M work papers in our indexes are notes payable. You should have an amortization schedule for each loan. Your CPAs will have that in their working papers. If you don't, you just get copies of that. Your line of credit should tie to a monthly bank statement at the end of each month. Each loan should tie to the amortization schedule balance as of the end of the respective months. Okay, and then here's a lead sheet that outlines, here are all my loans, and this was my balance at the beginning of the year, my payment, my interest portion, balance at the end of January, payment, interest, balance at the end of February, payment, the interest portion, balance at the end of March, so on and so forth. And so if you just do a column for each loan and a row, and then these numbers should all tie into your amortization schedules. Okay, so this is a good example of a good thorough set of work papers for your loans for the year. Okay, and the loans would support the balance sheet, the trial balance. So the next concept would be accounts payable. So we have a lead sheet for and working papers, organization, accounts payable. Here's your aging to GL reconciliation we talked about before. Let's run it again for accounts payable. Print AP aging. We go aging to GL reconciliation. This is exactly the same report like we mentioned before, so you do have to pick AP, and then you say 12/31/2012, end of the previous fiscal year end, and then the end of the month that we're tying out. And so then we're looking for this to be a zero balance all the way across. Okay, so this looks like we have kind of the same issue we had with receivables, but with our demo data. So this is what you're looking for, the balances to be there. So a good lead sheet there. So suggested working paper organization. N1 might be your aging to GL reconciliation sheet. Your N2 work papers, N2A through N2M would be an example of your accounts payable aging. Test of balance steps. Okay, verify the accounts payable trade AP accounts tied to the trial balance. Okay. Verify AP trade ties. Verify your AP retention ties to your trial balance, and verify everything on the aging makes sense and is correct. Okay. So getting an AP invoice off your books, consider doing a negative invoice instead of posting a journal entry. Then you will have to do a zero AP check to clear the positive or negative invoice. So let's do an example of that. And so we go to the aging and we say something needs to come off the aging. Okay. So maybe you didn't pay this because they didn't perform or something to that effect. So the 22, maybe you back-charged them for something, and so you have $22.50 left. You're not going to, let's say it was a back charge. So then you back-charge them. You incurred probably costs from somebody else to do that work. So AP invoice. Let's say that project, so we'll say A1. Okay. So say we had a sub that did the work. Okay, so that sub gave us an invoice for whatever it was, and now we back charge them, so we need to reduce our expense from that sub. Okay, so let's say it was the 1106 job, and let's say it was concrete. So this A1 asphalt messed up a curb, and you had to have the curb fixed, and so you increased expense on the curb costs. So this, it didn't really cost you more because you back charged the other sub. So in order to get the concrete right, you've got to reduce the concrete for what you back charged this sub, and maybe this sub's got, you know, a different cost code. So that's how you would do that. So we'll say okay there. So then we come over here to manual AP payment. And clear both items. 0 checked. Gets it off the aging. And this is set up for a subcontract control check stub, so I'd have to come over here and turn that feature off temporarily while I save, and then save it and turn it back on. Okay. The subcontract control check stub preference is here, by the way. AP, use subcontract control check stub. And what that does is it generates a check for each by job to the sub. Okay. Actually by subcontract, or it's by P, would be by subcontract to the sub. That way it can recap, you know, some of the AIA concepts on your receivable side on your AP check stub. So if you're not familiar with that feature and you do that, that's a really nice feature. So call in and do a support call and we'll show you how it works, or just help you set it up. Okay, so that's how you would clear that item. The next thing we want to talk about is your liabilities. So we go back to your index or trial balance. We're traveling down your accounts in your balance sheet, basically providing support for everything. So when we get to our liabilities, like our payroll taxes, okay. So here we're talking, not necessarily talking about payroll taxes, we're talking about accrued wages, labor worked in 1 month that's paid in the next month. To accrue the liability, the reason for accruing the liability, or the reason for accruing wages is to accrue the liability and then to also sync the job cost up with the general ledger. Your job cost reports are based on the work date that come off the time cards, and your general ledger is based on the check date. Okay, so if it's an AP invoice, the job cost is based on the invoice date and the general ledger is based on the invoice date, so there's no sync issue. It has to do with payroll and equipment charged through time card entry. So in order to sync those, you'll have the job cost is based on the work date. Let's say it's in January. The check date's in February, so the general ledger and job cost are out of sync, and that's why we accrue wages. So utilities accrue wages. If you don't accrue wages through the system, your job cost is typically not going to be perfect. Accruing wages is actually a daunting task to do it perfectly. And so that's why we do it electronically. So we have labor burden, we'll have workman's comp, FICA, FUTA, state unemployment, you know, 401k, that kind of thing. So you've got all these burdens associated with each time card row, and the time cards are paid in 1 month. That's when the general ledger transaction happens, like the payroll check, and then the accrued wage, the labor happens in the previous month, and the job costs will pick up all those costs as of 1/27/25 on the general ledger. If you don't accrue wages, then you're not going to be in sync. Your job cost is going to be off. So when you run this report, beginning of your fiscal year to the cutoff date. So it's always January 1st through your cutoff date. And down here you would have a difference until you accrued wages. Okay. If you have a difference after you accrue wages, it could be that you didn't accrue wages at the beginning of your fiscal year. And you could run that down by going to Analysis Reports, Payroll Accrual, and you would say, was I off at the end of the previous fiscal year? And you do that, and it tells you here we didn't have any accrued wages at the end of the fiscal year, so we didn't see anything. Let's say if I pick another cutoff date, I'll just pick like 1/12. And at 1/12, we actually did accrue wages. And so if I go Utilities, and there's a difference here. Let's see, accrue. The demo date has been around a long time. We just advanced the years. Let's see, Post and Preview. So then it accrued it perfectly. But typically, if you haven't accrued wages, you're gonna see this section blank, and you'd see a $12,000 difference here. That would be the end of your previous fiscal year. And we do come across users periodically that have used the system for a long time that are not accruing wages, and it's a real strong feature for the system. It really facilitates and it allows you to do the full summary of contracts, which we're going to cover here in a little bit. So accrued wages, let's touch the concept one more time. So this menu item allows you to post it and preview it. The menu item under General Ledger just allows you to see what's there without posting it. So we have the wages worked in January that were, the hours worked in January that were paid in February, the time card rows. And then here is an accrued wages journal entry, which is like our general journal entry for accrued wages. If we hadn't accrued wages, this would be blank, and then we'd have a $971 difference. Okay, so that's the accrued wages concept, and this would be maybe your O1 work paper. Okay, so our liabilities would be in our credit side in our example here. Other liabilities would be like your 941 liability, your state withholding, that kind of thing. And probably what you would do is you would look at the first payment paid in February in our example and see what period it was for. If it was for January, then that's what you would expect to see on your books as your liability, and you would compare it. If it was different, then you would try to run down why it was different. So periodically your accounts can get off, and if you are reviewing them every month, when they do get off, you get them fixed, and so then at the end of the year your books end up being a lot cleaner than if you would just ignore everything all year long and try to clean them up at one point in the year, or quarterly or semi-annually, or however you do that. So the next thing we're going to talk about is our job cost, revenue, and job expense. Okay. So what we have, and we'll go through our over under billings, the reports to print to show the job cost tab to the general ledger. So what reports that, and we use the job cost and number 2 job cost reports, print billings, direct costs and burdens summary. Okay, so same report we just printed. This is our report we generally do print, and this one includes a recap of the balance sheet, I'm sorry, the income statement at the bottom. So from the first of the fiscal year through the cutoff date, if our cutoff date was February, it would be January 1st, 2013 through February 28th, 2013. And so we're looking for this along the bottom. So this is the report that shows us our job costs sink into our general ledger. If job costs are off, we print the accrued wages at the end of your fiscal period, and then you print your accrued wages at the beginning of your fiscal period to see if they're off. GL number 7, print analysis reports number 4, accrued wages. We already covered these concepts. You print your direct cost, direct non-job exceptions report. In the system, we have these GL accounts that are set up for payroll burden. So our job-related costs get burdened, right? And the burden gets posted into these sections, direct to non-job. If you do any transactions outside of the system doing transactions into these direct non-job expense accounts, your job costs will be off. So you should not use those, let the system use those. Those are really just for the system. And the mechanics of how the payroll get burdened onto the projects, okay? If I come over here to summary of contracts, I can print my direct non-job exceptions and let's click preview. And if I'm off, it'll typically show up in there, direct non-job exceptions, okay? So it'll show there, and anything in there should come out. And you can do a support call, and we'll tell you how to do that and why, and explain it further if we need to. Okay, so print the summary contracts, print the SOC prior year amounts report. So if you're off, you might not tie into the summary contracts that are part of your audited, reviewed, or compiled financial statements. And so in order to tell whether you do or not, you'll print this report. So summary contracts, print prior year amounts. And we say enter the current, any date in the current year will give us, because it's going to go back to the prior year. And so it calculates the end of the prior year end, and it tells us what numbers the system has for those jobs that carried over. And you compare these to that summary of contracts you have, and then if you're not sure what to do, you can do a support call, and we'll help you through it, unless your CPA wants to do that too. Okay, so those are the 4 things we do to see when job cost doesn't tie in perfectly. Those are the 4 things that fix it 99.9% of the time. Come to a resolution on it. So other reports to help with your year-end, a report that the auditors can pull to export summary contracts data to Excel would be this print SOC worksheet. So if we come over here and we say job cost, print SOC worksheet, okay. Right there. Okay, so that's the summary contracts then. Let's go ahead and print that to your screen. Okay, so we have our completed jobs and our open jobs, and we have our over and under billings, and we're looking for this number and this number to tie into our income statement. So our job cost of 105,082 should tie in here. The journal entry, so we'll refresh it, 105,082, 105,082. And then the 138 at 961 will tie in here if we accrue our over under billings. Now there are different ways to do this. The job status would be if you project your projects forward. We can do the calculated. We covered the job status concepts in the cost control webinar and a couple of the other webinars, so I won't do too much on that now, but that allows you to project your jobs forward. There are also several ways to project the profitability in your projects. Here, see the 133 and the 67 will tie in here. And I'll say posted, it'll do my accrual and reversing entry. Refresh the income statement by hitting the lightning bolt, and my 138, 961 ties in here. So the over and under billings, mechanics of it are done for you through this area and allows you to tie your income statement into your summary contracts, proving that your job costs tie out. Now your indirect cost section is here, and So the question is, how do I know my job costs are 105,082? And you know because it ties into your double entry system set of books here, but your job costs are always off by your over under allocation of indirect costs. So if that's substantial, you should get that off your books, that over under allocation. So like every quarter, or every 6 months, or every year end, you would go into your burden utility grid, and you would actually wipe that out by allocating your indirect costs to your jobs based on some reasonable criteria. So we have the burden utility grid here. This will be the last thing we do in the webinar, by the way. So we're almost done. So let's customize the grid. The grid can be used in a lot of different ways. You can burden your costs based on, I mean, we have some real sophisticated things that go on with this grid. So if you need some unique burdening concepts, you need to apply them, then just need to do like a training session with it. So we're gonna do this in a way that most people do. So based on the cost code level. So we're going to keep it simple, which is what we like. So we'll turn those columns on. We'll say add. A doing it every month might not make sense, but at least once a quarter, every 6 months makes sense, I think. Because indirect costs can jump up and down and from one period to the next. We actually didn't need that as of date. So we're going to do, in order to allocate this number, we run this report over here, direct costs and burdens. Our start date's the same period that we're looking at. So this report will now give us the percentage we need to use. Now that 65.21309 is what we want. $21309. Okay, and we're going to base it on cost group costs, and we're going to base it on labor. Okay, so we're going to allocate our over under allocation based on labor. Now if we look at this report, what it does is it gives us our direct costs, and then it gives us our indirect cost pool, the subtotal, and then it adds back the accrued wages percent burden and the percent burden allocated to the direct costs, which is this number here. Accrued wages, we're looking at costs that were posted in February. The job cost picked up 240 in burden. It didn't hit the general ledger until February, so when we accrued our accrued wages, we had to accrue that 240. So that gives us a subtotal of 8515. That's our total indirect cost we incurred. Here we're dividing it by our gross labor. This is the simplified approach, and it's really probably 90% of the companies out there should be using it, general or sub, and that's my opinion. So that's our computed number to get our indirect cost to be perfect. Now the estimators always ask what the loaded labor factor is, and this would be what that is. So you have your 401k, all your payroll taxes, insurances, and then that 65.21 we computed there gives you an 89, in this example, 89.73 factor. So the estimators, if the average wage is $20 in the field and they're estimating it at, 1.8973 times $20, let's say it's $38, then they're close. Let's go over there and we'll allocate it. So to move off that row and save it, and we'll say execute and post. We'll generate the transaction. Now, one thing that you want to do, you want to pay attention to your valid entry date range. And so I posted it. If this is outside your valid entry date range, it's going to tell you you're outside your valid entry date range. You should always close your books when your auditors pull your trial balance. Okay, and then it depends on the philosophy of your company as far as, if you want your monthly financial statements, lock them down, close your books monthly. That's a good concept. So if we come over here and we refresh this report, you'll notice that we're not perfect. This did actually make it perfect. But remember, we had the accrued wages. And accrued wages, we changed those burdens. So now what we have to do is re-accrue the wages, because we put a different burden factor on those wages that were paid in February that were worked in January. So now we have to accrue our wages again to get it perfect. So post and preview. So that'll pick up our adjusted burden number. And then we refresh our report again, and it's 3 cents off. So now our over-under allocation of indirect costs has been trued up. Refresh our income statement, you'll see that here. And so then the job cost reports will show $109,000 in cost for the year. Okay. So 109,680 ties into your total job cost now that you've trued up your indirect costs. So one question that people will pose is, shouldn't I do that monthly? And I think the answer is probably no, because your indirect costs can be, there are two different, there are different components of indirect costs. Some components are fixed, some are variable. And typically your indirect costs will jump up and down. So maybe over a 3-month period, they're somewhat normalized. And so doing it every quarter might make sense. Doing it every 6 months might make sense. And I know a lot of companies do it every year. And maybe every year is appropriate if you're reviewing the loaded labor factor that you should be using in your estimating process every year. You should do it every year. If you're doing it every 6 months, then maybe every 6 months. Every quarter, then every quarter. So that's how I would gauge it. However, whenever the estimating, you're supporting the estimating process, calculating that loaded labor factor for them, because that affects how they estimate projects. And one of the primary objectives of your accounting process should be to support your estimating system. So you want an information system. You don't want a bookkeeping system. And so this becomes more of an information system when you're doing these kinds of things. If you're using the system like people use QuickBooks, then you've got a bookkeeping system. So you want to grow and do this as much as possible. This webinar will be on the website hopefully by the end of next week, so you can review it again and again. And then we'll continue to do this webinar and post newer versions of this as we grow and do better with it. So anybody have any questions?